Good afternoon and welcome to Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. We've been broadcasting live from inside ETFs in Hollywood, Florida, and joining me now is Simeon Hyman. He is the head of investment strategy over at ProShares, and we're going to discuss investing in a rising interest rate environment. Simeon, thank you very much for joining us at the conference. But when's the last time we spoke about rising interest rates?
Well, we've been anticipating it, but at this point, we now have this big fiscal stimulus known as a tax cut. At the same time that it's maybe a little late for that. It would have been good 8 or 9 years ago, but when it comes with 4% unemployment and globally synchronized growth, the bond yields have been rising and interest rates picking up, and inflation as well.
How can investors participate in this with interest rates on the rise?
Well, one simple way that we have is to just simply deploy inverse bond ETFs. At ProShares, we have a suite of these, and they are an opportunity to have exposures such as TBT, which is minus 2x to 20-year Treasury, and we have a suite of different tenors across the curve and different multiples, so that people who can construct their portfolios have the tools to fight against the decline in bond prices that happen when yields go up. That's certainly one way. A second way is we have two packaged ETFs which have built-in hedges. IGHG takes a portfolio of investment-grade bonds and hedges the interest rates, rebalances it for you every month so that you have the hedge taken care of for you, and HYHD is high yield. So both for the do-it-yourselfers and on a package side, on the fixed income side, we have the tools.
Let's talk about Nasdaq-listed EQRR and what that's designed to do.
So EQR is equities for rising rates, and how the equity markets react in rising rates is a tricky one, because the great thing about equities is earnings can rise, growth can accelerate when rates are rising, and equities can do fine. But that is still a challenge because rising rates do affect kind of the discounting mechanism of stocks. What we've done is we've taken an approach to study the relationship of various sectors in stocks to rising rates, and have put together a system for picking stocks within the sectors most correlated with rising rates, and as well as the individual stocks most correlated with rising rates, to design the first ETF designed to outperform when rates rise.
And how's it performing so far?
Well, we launched in July, and it's not a long time, but we happen to have launched it in this period when rates are rising, and it's actually outperformed the S&P by over 1,000 basis points since its launch. So far, so good.
All right. Well, thank you very much for joining us today. And traders, as always, thank you for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.